For centuries, people have told the story of money as if it were a neutral invention, a clever tool that made trade easier and societies more efficient. Coins replaced barter. Banks replaced mattresses. Numbers replaced trust. It sounds clean, rational, almost inevitable. But that version leaves out the uncomfortable part. Money has never been just a tool. It has always been a relationship, okay? And whenever that relationship breaks, history doesn't collapse quietly. It fractures violently. If you want to understand this, you don't start with emperors or wars. You start with promises. Because money, at its core, is a promise that strangers agree to believe. The moment that belief weakens, power shifts, sometimes slowly, sometimes overnight. Welcome to the financial memory, where money, trust, and history intersect, and where the most important forces are often the ones you can't see. One of the most revealing moments in financial history didn't come from a battlefield or a revolution, but from a simple administrative decision in medieval Europe. For hundreds of years, silver had anchored everyday economic life. Wages, rents, taxes, and debts were calculated in metal that people could weigh, touch, and test. It wasn't perfect, but it was legible. You knew what you were being paid, okay? And more importantly, you knew what the state could realistically afford. Then something changed. Rulers discovered that control over money didn't require more silver. It required control over definition. Coins began to look the same, but contained less metal. The stamp stayed official. The weight quietly fell. On paper, nothing changed. In reality, the social contract did. This wasn't counterfeiting in the criminal sense. It was legal debasement, sanctioned by the crown. From the ruler's perspective, it was brilliant. The state could pay soldiers, fund construction, and settle debts without raising visible taxes. The population would feel inflation, but inflation is abstract. It doesn't arrive with a bill. It arrives with confusion. Prices rise unevenly. Wages lag. Blame spreads sideways instead of upward. What rulers learned very quickly was that money could be used to shift pain without announcing it. And once that lesson was learned, it was never forgotten. But debasement had consequences that went far beyond higher prices. It altered how people related to authority itself. When money became unreliable, contracts became fragile. Long-term planning stopped making sense. Merchants shortened their horizons. Lenders demanded higher premiums. Trust narrowed inward toward family, guilds, and local networks. The state gained flexibility in the short term and lost credibility in the long term. This pattern repeated across continents and centuries. Whenever political power faced pressure it couldn't solve through taxation or growth, it reached for the monetary system. And each time, the same dynamic emerged. A good decision was framed as technical, temporary, or necessary. The fallout was social and permanent. By the early modern period, this logic evolved into something more sophisticated. States didn't just alter coins, they created paper claims, notes that promised redemption later. Bonds that promised repayment over time. Became explicitly tied to the future, not the present. It's unlocked enormous power. Governments could mobilize resources far beyond their current income. Wars could be fought on credit. Empires could be expanded before they were paid for. But this also meant that trust was no longer local or personal. It became systemic. People weren't just trusting a coin. They were trusting an institution to exist, function, and honor its obligations decades into the future. The strength of money became inseparable from the perceived stability of the state behind it. This is where money stops being an economic instrument and becomes a moral one. Because once a society runs on promises, the character of the promise maker matters. When governments honored their debts, money stabilized, investment grew, and power consolidated peacefully. When they didn't, the consequences weren't just financial, they were political. You can see this clearly in moments of crisis when states push their monetary systems to the edge. Inflation accelerates. savings evaporate. People who follow the rules find themselves punished, while those closest to power find ways to adapt. The public doesn't need an economics degree to understand what's happening. They feel it. And when trust breaks its scale, it doesn't just produce anger. It produces withdrawal. People stop believing official numbers. They stop believing forecasts. They stop believing speeches. Eventually, they stop believing that participation is worth the risk. In a society where money is distrusted becomes a society where cooperation is fragile. What's striking is how often leaders underestimate this effect. They treat money as a lever they can pull repeatedly without consequence. But money remembers, accumulates. Every temporary measure becomes precedent. Over time, citizens adjust their behavior to protect themselves, not the system. They speculate instead of save. They hoard assets instead of investing. They look for exits instead of opportunities. From the outside, it can look like irrational behavior. From the inside, it's survival. Modern financial systems are more complex, but the underlying logic hasn't changed. Central banks speak in neutral language about liquidity, stimulus, and stability. But beneath the terminology lies the same ancient tension. How much can a state ask of its currency before belief gives way to doubt? How much flexibility can be extracted before trust becomes optional? The most powerful governments today understand that credibility is their most valuable asset. Not military strength, not GDP figures. Credibility, the belief that the numbers mean something, that the rules will still apply tomorrow, and that promises won't be quietly rewritten when they become inconvenient. This is why financial crises are never just about money. They are about legitimacy. When a currency collapses, it exposes fractures that were already there. When a banking system freezes, it reveals which relationships were built on trust and which were built on assumption. The damage lingers long after balance sheets recover. History shows that states rarely fall because they run out of resources. They fall because people stop believing the system is fair, predictable, or worth defending. Money is the medium through which that belief is tested every day. The deeper lesson is unsettling, but clear. Power doesn't come from printing, minting, or issuing. It comes from restraint, from knowing when not to push the system further, from understanding that trust, once lost, is expensive to rebuild and impossible to fake. Money is not just a measure of value. It is a memory of behavior. It records how institutions treated their people in moments of stress. And long after policies expire and leaders disappear, that memory continues to shape how societies respond to the next promise they're asked to believe. In the end, financial systems don't fail because they are complex. They fail because they are human, reflect our incentives, our shortcuts, and our willingness to trade long-term stability for short-term relief. And history suggests that the most dangerous moment for any system is not when it runs out of money, but when it runs out of trust. Because once belief is gone, no amount of currency can buy it back. This is what the financial memory exists to remember long after markets forget.